When we invest in dividend-paying stocks, we do it because we want to earn dividends for the next 20, 30 or 40 years. But a dividend-paying stock is not a bond. Companies are not legally obligated to pay dividends, which means that any company can reduce or cut their dividends. Companies don't have to pay dividends. They only pay dividends if they can pay dividends and if they want to pay dividends. So obviously we want to invest in stocks that won't cut or reduce the dividend. Of course, nobody knows the future, so we can never be 100% sure that a company will keep paying dividends. But there are a few ways we can reduce the risk and reduce the likeliness of a dividend cut. First of all, we want to look for companies that want to pay dividends. So how do we know if a company is willing to pay dividends in the future? We need to look for dividend growth companies. These are companies that are raising their dividend payments for 10, 15 years or even decades. For example, take a look at the dividend history of Pepsi. This is a typical dividend growth company. You can see that they are paying and raising their dividend for decades now. What is important about this is that when you see a dividend history like this, you can assume that the company will probably keep paying and raising their dividends if they can. Another assumption we can make here is that the company and the management know that investors expect this dividend growth. So the company will probably do everything in their power to keep this dividend growth. Of course, the dividend history alone is not enough to be sure that the company won't cut their dividend, but this is the very first step to filter out stocks. Because let's take a look at the dividend history of another dividend-paying company. This is a company called James Hardie Industries. This is a dividend-paying company too, but there's a huge difference. As you can see, sometimes they pay dividends, sometimes they don't. So it's totally unpredictable. If you had bought this company last year with a 4% dividend yield, today you would have a 0% dividend yield because they cut the dividend, as they had cut it several times in the past. So it's not the price chart you should be looking at, and it's not even the dividend yield, because you cannot predict anything from the price chart and you cannot predict anything from the dividend yield. The very first thing you need to look at is the dividend history of the company. But the dividend history alone is not enough, because there are many dividend growth companies who cut their dividend in the past. Even though many companies want to pay and raise their dividends, not all companies can pay and raise them. And this is because a dividend can only be paid from profit. If the company cannot grow its profit, it cannot grow the dividend payment. This is very obvious. So another thing we can look at is the revenue growth. This is the revenue of Johnson & Johnson for the past 37 years. As you can see, it's growing year over year. And this is important because if the revenue is not growing, then you cannot expect the company to raise the dividend. A dividend can be only paid from the money the company generates. Of course, if the revenue is down for 1 year, it's not a huge problem. But if the revenue is going down for 5 or 10 years, then it's just a matter of time until the company will cut the dividend. Another thing we need to check is the debt level of the company. Why? Because, as I mentioned many times before, the company is not legally obligated to pay dividends, but they are legally obligated to pay back their debt. So what happens when a company has too much debt and the revenue drops for any reason? There's a high chance that the very first thing they will do is cutting the dividend. So how do we check the debt level? We measure it relative to the earnings, more precisely to the EBITDA, which is earnings before interest, taxes, depreciation, and amortization. You can easily find the debt to EBITDA ratio of any company by just a simple search in Google. First of all, ideally, this number should be getting lower and lower every year. If the company is growing its debt at a higher rate than the revenue, then it's a problem. So a declining debt to EBITDA ratio is better than an increasing one. And also, this ratio shouldn't be too high. But what's too high? Well, this can be different in each industry. So we can check other companies in the same industry and compare it to the industry average. So all in all, even though this is not a complete analysis of dividend growth stocks, these are some of the few important facts we need to check before we invest in any stocks to make sure the company won't cut its dividend in the future.